Well, as you know, my name is Walter Peters, and you're here at the Naked Trading webinar, and we're going to talk about tops and double bottoms. I'm going to share with you not only some of them that were talked about in the Naked Forex book, but some that I've been trading since then, since that book came out. And we'll talk about optimizers, ways to improve your reward to risk ratio, the trade-offs, everything, basically the way that I see it from a naked point of view. Does that sound good to everybody? You ready to roll on that? Because I am. I am definitely ready to go. So let's do it. Thanks everyone for spending time here, and thanks to those of you taking time out of your day to watch the recording. All right. So what I want to do here is I just want to make sure that I can see your questions as well. So if they roll in here, I will catch them. All righty. Okay. So first of all, the big picture here is that the double top and the double bottom formation, and I'll give you guys some notes here. If anyone has a pair that you want us to look at, we can, but I've got a couple here in mind just to illustrate a couple of points. You could post them in the, excuse me, sorry guys, I've been on holidays and jet lag, just arrived today back home, back into winter from what was a blistering hot European summer. At least it was the last 5 weeks. Okay, so what I'm going to do here is, so yeah, it's nice to be back in the cool weather of Australia, I suppose, until September when it fires up again. But the things about the double tops is basically the market is moving in one direction. Now, the reason why I like it this way is because what you're trying to do here is it's really, as I see these double tops and double bottoms, they're swing trades. So you're trying to get in on a swing point. And so if that's the case, we need to know what was happening before we reach that swing point. So if we see a double bottom, really the market should have been moving down. Like you can see here on the Kiwi, the Kiwi's moving down, okay? And then it reaches this level down here. We'll talk about this as a potential trade here and a lot of the different ways that you could have approached this. But the key thing here for me, some people might look at a consolidating box and say that that's a double top and that's a double bottom. I do not. I do not. And also likewise, they might look at a retracement move and say, oh, I made a double bottom on the retracement. That may be the case, but when I talk about double bottoms and double tops, I'm really talking about taking a reversal trade, and you're saying, look, you're identifying this as a swing point. So that's really what I'm talking about. Okay, so the market's moving in one direction. So for example, on this Kiwi here, this 4-hour Kiwi chart, what you'll notice is that the market's been moving down, and then it reaches this level. Now, I don't think that I didn't have this level marked as a really good support level. Maybe some people did. And for the purposes of this, I'm just going to go ahead, and what I'm going to do is actually make it gray so I remind myself that probably take that one out later. So what I want to do here is like, okay, the market's moving down, and then it makes, boom, the first touch. Okay, we'll talk about a couple of different setups here, patterns. They're not all, what you think of as a double bottom may not be included in what we look at today, which is cool. It just, it gives you new ideas to test. And then the second one is actually right here. Now, we have to be careful and not let any hindsight bias in. So we're going to say that we've seen the market touch here and here, and we've decided that this is a level we're going to watch. So the market comes down here, it touches, and it moves away. So it needs to be moving in one direction. In this case, it's been moving down. And then it needs to move away from a support and resistance zone. It doesn't matter if it's moving down from a resistance level or up from a support level, but the market moves away from zone. So after touch 1, the market moves away from the zone. All right, is everyone clear on that? Does that make sense? So the market's moving in one direction, and then after touch 1, the market moves away from the zone. That's what we have here. The market's come down. All good, says Phil. Thank you very much for your feedback, Phil. Boom, we touch, and then we move up. Now, what really makes this a double bottom or a double top is what happens next. All of this other fluff, 1 and 2, that's just like prerequisites, right? So when I went and did a degree in psychology, we had to take prerequisite courses. We had to take research methods, statistics, introductory to psychology before we could take the upper level advanced stats, right? And I'm sure it's the same in engineering and political science and any other degree. But that's kind of like the baseline. We need these two things, and then we, boom, move on to number 3, which is the second touch is higher for a bullish whammy trade or lower for a bearish moolah trade, okay? Okay, so this is the critical piece here when we're talking about whammies and mullahs. We'll talk about other systems in a minute, but when we're talking about whammies and mullahs, this would be a whammy here because the market's come down, it's touched, it's moved away from that. Notice how really you would say like maybe 2 to 4 candles touched, maybe 1, 2, 3, 4 candles touch this zone, and then it moved away, which is critical. It needs to move away. If it doesn't move away, you're probably looking at consolidation, and you're probably going to get blasted. It's probably going to keep going lower. So it really needs to have that upward movement, and the line chart will tell the story. So you can see here on the line chart, which is just a 1 period moving average on the closing prices, really. That's all a line chart is. It's a 1 period moving average on the closing prices. So it goes boom, 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 moves up. And now what I'm looking for here is that touch number 2. So I'm hit the F12 key on my MetaTrader, and boom, we've got touch 2 right there. Okay, now this is where I want to give you some optimizers and some options. So depending on how conservative you are or aggressive. So let me explain what that means. So if you're really conservative, you probably like to win more than you like to lose, and you probably, you're not going to be too upset if you're getting like a 2R or 2.5R result on your winners. Everyone familiar with R? R, of course, is the risk on a trade. So if you're making 2R on a trade, then you need to win like 66% of the time to basically break even. Sorry, did I say 66? 33%, we'll call it 34% of the time. You basically have to win 34% of the time to break even. If your winners are twice as big as your losers, right? That would be a 2R result on your winners. Now, this thing right here, I would not call this a nice touch on the second touch here. And that's not because of what I see that happens to the right here, because I know what happens next, right? I like to see my second touch give me, as a signal candle, a really strong bullish candle on these whammies. And obviously the reverse would be true for a mullah, a bearish candle. So the second touch needs to be higher than the first touch. Now that's true. That's true. So far, the lowest low we see here is this candle right here with a low at 67.19, 0.6719, whereas the low in this candle is only as low as 67.23. So we are lower here on the first touch, which is great. So this is all setting up nicely to be a nice whammy trade. But look at this. This candle here is so weak. It hasn't closed above this previous candle's high. That's really what I would like to see. Ideally, is one of these candles really soon, because the longer it sits here, the more likely we are in a consolidation and we're going to fall through and go lower. I really want to see a move away from it quickly. And we really don't get that until here, this candle. So this would be, and again, this has spent 1, 2, 3, 4, 5, 6 candles on support, which is not ideal. You really want to see with these double tops and double bottoms, well, in my testing, what I've noticed is I really want to see 2 distinct V's, right? So this is not, this is a bad sign. This is a really bad sign that it didn't move away quickly. It should have moved away like on this, or this candle. It didn't. It didn't really move away till this candle. So that's not ideal. But let's say I'm willing to overlook that. Let's say I really like the idea of going long here. This is a really nice zone. So I want to go along the New Zealand yen. Oh, sorry, the New Zealand yen, the New Zealand dollar. So this is the Kiwi against the USD. Well, here's the interesting thing. If I'm a conservative trader, I wait for the bullish candle to print. And if I'm the conservative trader, I also put my buy stop above the high. Now, why that's important is because as you're going to see right here, hang on, as you are going to see right here is the market. So I'm going to put a little green box here to signify that, yep, I'm going to go long when the market breaks higher than the high of my signal candle, which is this big bullish candle, right? So look at that. There's my buy stop right there, okay? I'm conservative. Now, if I was an aggressive trader and I wanted really high reward to risk ratios and I didn't mind if I had a lower win rate, then I might have considered to go long on this little blue candle here and count that as a second touch instead of counting the other one. But that's not my style. That's a really aggressive play, and I don't typically do that. So that would be the case. Like looking at this and going, yeah, I want to go long. But even then, notice, the market doesn't trade higher than this candle over the next two candles. So I like this rule is if you've read my book or watched these webinars, you know that I like to trade. With buy stops and sell stops. Buy stops on buy trades and sell stops on sell trades. In other words, I want the market to push higher before it takes me takes me into the trade, triggers my trade. And by the way, on the whammy trade here, the stop loss is below the lower low, which is the first touch. So your stop loss would actually be down here. I forgot to mention that. Sorry for those. I sometimes assume that that people know that, but obviously the stop loss goes down there. So here's what's interesting here. If you take the aggressive one, which we'll make this one the purple arrow, okay? We'll call this one the purple arrow. If you take the aggressive play here, which I still don't think you can make a case for this, but let's say you did. Because it's not an inside candle, but boy, it's almost an inside candle. And then you get two inside candles afterward. So let's say you wanted to go long here. You put your order above the high of this bullish candle here. Guess what? Candle 1 and candle 2 never trigger. So right away, I would take that order away and say, nope, no trade. Then I get the bullish candle. I say, okay, well, now we're talking. So I'm like, okay, it's going to go now. But guess what? Candle 1 doesn't trigger, and candle 2 still doesn't trigger. So at this stage, again, I'd have to remove the order. So this is an example of a whammy trade that would be a no trade. And the reason why it's a no trade is because the market did not trade higher after two candles on the really aggressive, not even very nice looking bullish candle. And it certainly didn't trade higher than the really beautiful looking bullish candles. Too bad we couldn't just lift this candle and put it over here, because that would kind of make the really nice setup for us. But anyway, it didn't trigger there after two candles either. So it really was a no trade. And at this stage, because we're inside this box, I would argue that what we're looking at here now is a consolidation box. It's very, very likely, in my humble but sometimes accurate opinion, that it's, I don't know why I think that's funny, that it's actually going to go lower. That the most likely result here, let's look at the big picture. Yeah, the most likely result here is it's going to break through here and fall lower. To me, that's my belief based on this move. Okay, are there any questions about any of this? Is this making sense, or do you have any? If you have any questions about this, is the sort of the standard whammy trade. Now, before we get into the more sophisticated means of doing this. All good? Or questione? Preguntas? Anybody? I want to make sure that it's really clear. All good. Okay. All right, cool. I just want to make sure that you're clear on this. Obviously, if you're looking at a moolah trade, it's the exact same thing. The market's moving up. You know, we might have had one here like on the 1 hour charts, I'm thinking. Let's just go and see here on the 1 hour charts if that's true. Am I telling a fib or is this true? Yes. So this is an example. Hang on. Yeah, just. So this would be, in this case, we would have touch 1 right here. We would have touch 2 right here. And the bearish candle for me would be this candle right here. So let me zoom in here so everyone can see. Just want to make sure everyone's clear on this. So you got touch 1 right there. You got touch 2 right here. So this touch 1 is actually 1 pip higher than touch 2. Okay, so the market's been moving up. It hits a level. This is a clear level on my zone. By the way, this this line was drawn before the market did this, right? This line was drawn a long time ago, not when this happened. There'd be touches way back here to the left. But anyway, now the trigger candle for me on this one would be this candle right here. I could go with the kangaroo tail. That's certainly a possibility. That would be an aggressive play. My stop loss, of course, would go above our first touch over here. So be right here would be the stop. But my thinking on this would be that it's a pretty nice looking kangaroo tail for sure. So I could put a sell order below there and it's triggered immediately. But more likely, I'd probably wait for this bearish candle to print. And then once that prints, I go ahead and I put my little sell order in and it actually triggers on the very next candle, which is really what you want to see here. So the very next candle trades lower. And, you know, it depends on the time frame. If I'm trading the 1 hour chart like this, it might be like 3 pips lower. If I'm trading the daily chart, it might be 7 pips. Well, the 4 hour chart might be, 6 pips, something like that. But that's what I would do in this case right here. This is an example of a moolah trade. So all the same things that we've looked at. Excuse me, I do not understand what is the example for the double bottom. All right, so the double bottom, no problem. So the double bottom over here was is this right here. The market's moving one direction, which is lower. The market touches a support and resistance zone and moves away from it. So that's touch number 1. And that's the lowest touch. It makes the lowest low. The second touch actually makes a higher low, which is what happened here. You can see the low on this candle right here. If you look down here at the MetaTrader thing, see how it says low? So you can see the low right there is at 67.19. The low right here is at 67.23. So it's actually a lower low here. And then what I do is I wait for a bullish candle to go long. I would not say that this little blue candle would qualify as a bullish candle. Ideally, it would close above the open of the previous candle here or even above the high there. We don't really get a bullish candle until this candle. Once we get a bullish candle, I put my buy stop order in and I wait 2 candles. It does not trigger after 1, 2 candles here. And even if I went on the aggressive candle right here, it would not trigger after 2 candles. It did not. So in both cases, it's a no trade, and that's a good thing because looking at this chart, it's looking like it's going to consolidate here and drop lower. So it would have been a loser anyway. It would have eventually hit this stop loss down here. So that is a whammy trade, a double bottom. This is a moolah trade. We're going to break down this on the 1 hour chart, which is essentially the exact same setup, but in reverse that we just looked at. So here you have touch number 1. It's the highest touch, made the highest high. It did in fact make the higher high by 1 pip here. This is the second. So then it makes that touch, touches the zone, it moves away, comes back up, touches the zone again, makes a lower high. Very important for the moolah. So this moolah trade is a special case of the double top, just like the whammy that I just showed you on the 4 hour chart is a special case of the double bottom. So when it touches, the real question becomes, once you find a zone and the market moves up and hits that zone and then moves away and then hits it again, ideally these 2 touches are within about 10 to 20 candles. Ideally that's what you want to see here. So first touch here, the market moves away, and the second touch over here is on candle 14. That's pretty good. That's a pretty nice time. I don't like to trade them when there's like 65 candles between touches. And I also don't like to trade them when there's like 3 candles between touches, because I've noticed that those are often breakouts and more likely to be breakout plays than reversals. So I really kind of like the sweet spot here of between 10 to 20 candles between this touch and the second touch, right? So this is the exact same rules in reverse. We finally, if we don't go with this aggressive candle here, again, the stop loss is up here. So if we went with an aggressive play off the kangaroo tail, which again would be a much better trade in my estimation than what we saw on the 4-hour bullish setup, the whammy trade, this would be a pretty solid choice. You got about 16, 17 pips of risk here. Overall, there was about 36 pips of reward available if you decided to go here, but I probably would have targeted down here about 50 pips. So I probably wouldn't have made it until this move down here, you know, right around here. I would have had to withstand this pullback. Now, if I moved to break even, I would have been stopped out right around here. Even if I got in here off this candle, I would have been stopped out. As you can see right here, very likely to have been stopped out there. Maybe might have survived it, but very likely to have been stopped out there. So that is a case of a moolah trade where, again, first touch is higher, second touch is lower. Wait for the trigger candle, which is the bearish candle, and that gets you in the trade. The stop loss is always above the first high. Everyone cool on that? Because I want to move on to the Ghost Peak and Ghost Valley, and then I want to move on to alternative entries before we go and look at the live markets. Certainly, if you have any charts that you want to have a look at today in terms of just looking at the chart from a naked perspective, we can do that at the end of the webinar. I just want to make sure I cover all of the material for you today. All right, so now let's talk about another type of setup that it's going to seem like it's the opposite of the moolah and the whammy, but it's not. It's just slightly different. And let me share with you what one might look like. I'm just gonna, I'm not actually trying to, holy cow, the pound is in the toilet. Oh my goodness. I wish the pound was in the toilet when I was in London last week or yesterday. It's funny that it's just gone now. Let's see here. Let me find a lovely looking Ghost Valley or Ghost Peak for you so you can get an example what this looks like. Let's see here. Nope, that's not going to work. Aha, here's one actually right here. Beautiful. Okay. Again, I'm gonna put in the zone right here. I know I don't have one on the chart. You could certainly argue that you have one here based on the price action, but I'm gonna hone in on this little move right here in February 14th, right around Valentine's Day. See if we can zoom in on that sucker. Yeah, I don't know if this is gonna work out in the 1-hour chart or not. Okay. All right. This is a very aggressive play, but for some people, this is going to make a whole lot of sense. So let me share with you the Ghost Peak setup. All right. Okay. Here, let me zoom in a little bit more. Just want to make this very clear so everyone's clear on what we're looking at here. Okay, cool. All right. Now, this is a totally different setup. Ghost Peaks and Ghost Valleys. What happens here is, again, the market's moving up. It hits a significant level right here, which I have here drawn as 89.0, basically 89.08. So the first touch is right here. Now, what's interesting about this sucker is it hits it, it pulls back, and now, remember, in the standard moolah trade, with the second touch, should it be higher or lower than touch number 1 with a moolah trade? Those of you that have been paying attention are going to get extra credit right now. So with the standard moolah, touch number 2 is higher or lower than touch number 1. With a standard moolah, would the second touch be a higher touch or a lower touch than this first one? it would be, in fact, a lower touch. The definition of the special case moolah double top or whammy double bottom is that the second touch is always in the direction of the trade. So in a normal double top moolah here, we would look for this second touch to be lower, okay? So you might, in fact, go, we topped out here. The high was at 89.09, and the high here is at 89.08. And so, this is the top. Again, this is not a bearish candle. I don't like this candle whatsoever. I don't think it's a very good bearish candle at all. I think this chart at this stage suggests more likely it's going to break higher than lower based on the price action. But, some people might go, well, okay, it's touched it again and it touched it lower. But, to me, this is a terrible entry candle. But let's just see what happens next. Okay, now we're getting somewhere. Okay, well, maybe it's pushing off here and it's going away. And I put my sell order down here below the low. That would be a standard moolah trade, right? However, that's not what the ghost peak is. The ghost peak here, what happens is, you can see, is the market actually makes a higher spike beyond touch number one. So with the ghost peak, and obviously the reverse is true for the ghost valley, the second touch is actually higher. But there's a very important characteristic of touch number two. So let me put the ghost peak rules up here. Market moving up. This is just going to be ghost peak. Ghost valley would be the reverse. So it would be market moving down, for example. Market moving up. First touch on a zone. And then second touch makes higher high. Okay, that's really important because that's where we're diverging now from the standard moolah double top. The second touch makes a higher high, and that is actually in case that is true here at this candle, but is especially true here. What we're really looking for here is because let's think about what's happening in the market. There are a bunch of bears that went short at this touch here, at this support resistance level touch, and their stop orders are all up here. So what the ghost peak is trying to do is trying to take advantage of the fact that we know there's a whole bunch of orders here that we want to cash in, right? There's a whole bunch of buy orders here. So we know that if we can run the market up here, it's going to do a little spiky thing, like a little tail thing like this. So we're trying to take advantage of that. We still think that the market's going to hold here and it's not going to break higher, but we think it's going to at least do a false breakout and shake out some of the bears here. Also, there's a lot of breakout traders that also have buy orders here. There are a ton of buy orders above every swing high. That's just like there's a ton of sell orders down here. There were a ton of buy orders here that were triggered over here. That's how the markets work. People are always putting their orders above and below these swing highs and swing lows. So we know that this is the case. So what we're waiting for is that second touch to make a higher high. However, and this is the critical aspect, a lot of times you will not fulfill this fourth characteristic of the ghost peak or the ghost valley, which is this. Number 4 is second touch closes lower than first. This is very, I can't emphasize this enough. This is really the defining feature of the ghost peak. The second touch number 2, must close lower than the first touch. Now, what is the close of the first touch, you might ask? Well, the close of the first touch is going to be defined as the highest close over here. So the highest close is this bullish candle right here. Obviously, this bearish candle has a much lower close. So the highest close is actually this bullish candle here, and that close is basically right on the zone at 89.08. So we would put our zone right there. In fact, that's what I like to do. I like to put my zone right on the thing, right on the close, so I know if it's a ghost peak or not. So now the question becomes, do any of, does my spike here, when the market spikes through it, does it close above the close over here? And the answer is no. Even though the high is higher, it actually closes lower. And that, my friends, is the critical defining feature of the ghost peak. Because think about what we're saying here. Number one, the market's been moving up. Number two, the market's reached a level which historically has provided support and resistance for the market. Number three, the market, the market touches that level and then moves away from it, moves lower. Then it touches it again, actually moves higher, but it can't close any higher than it closed over here on the first touch. So what we're seeing here is actually weakness. Even though we're making a new high, we're seeing weakness, and you're always going to see a long tail. Now, the aggressive play on this one is actually to get in right here, right now, right here on the close of this candle. Now, you might be thinking, well, hey, Walter, why wouldn't you have gotten in on this first candle? And the answer is you could have. You could have. I don't typically like to take ghost peak trades were just slightly, above the first touch, which would be the case here. You can see the high here is at 89.10 and the high over here was at 89.09. So it's actually only 1 pip higher. I like to see it actually blitz through it and go much higher. You can see the high here is 89.19. So that's a good, 11 pips higher or whatever. Well, whatever it is, 10 pips higher than the first high over here. So this is actually a really to me, a really solid candle. But either way, the stop placement, which is number 4 in our process here, the stop placement goes where? It actually goes above the second touch. So stop loss above second touch. So what we're doing here is we're saying, look, we think the market's hit the end of the line here. However, we don't really know, we're not really sure if it's going to spike again, okay? And if it does, we want to survive that spike. So I actually am pretty conservative with the stop placement. I wouldn't put it right here, right at the end of the tail. I actually give it a little bit more room in case it wants to spike again, So in this case, on this euro pound, which euro pound is a pretty low volatility pair actually, the stop loss, again, remember you're entering right on the market, so right at the close of this candle. So you're getting in right here. Stop loss might be about 26 pips on this sucker, okay? 26 pips. So that means it's got to go about 50, 60 pips for me to get interested in taking profit. So that might mean all the way down here to this zone down here. That'd be 64 pips. So that would put me better than 2 to 1 or even down here, which now, now we're talking like 4.3 R or something like that. All right, so hopefully this is making sense, guys. So that second touch, you put the stop loss above that one, and I give it a good cushion. And then let's see what happens here. We're moving a little bit higher. Notice that if we had a sell order below this ghost peak candle, it wouldn't have been triggered, right? So again, it's an aggressive play. We're trying to get in at a really tight stop, and a lot of times it will give another push even after that long wick candle. So in this case, we do get down here, and do we get down here? We do get down, do we? Oh, we do get down here. So there's your 2R, I believe. Is that right? Because that was 26 pips. This is 63, 64 pips, I think. Actually, we haven't actually touched the line, have we? There we are. And then here's your 4R. Are we going to hit 4R? 4.3R, whatever it is? Maybe not. Yep, there, you finally hit it there. Boy, that was a long trade, right? That was a couple of weeks. Okay, so that would be, boom, the 4R result right there, 4.3 or whatever that is. I don't know what the math is on that. You know what I mean. So that's a ghost peak trade, okay? Same thing would happen with the Ghost Valley. Now, I want to talk, are there any questions about that? I just want to make sure everyone's clear on that. It's making sense. It's all good. So you see how that differs from whammies and moolahs. It's very different. It's a much more aggressive play. But there, see, here's the great thing about this. Of course, you can tweak this. So just as we tweaked the, I showed you the entries, the available entries for the moolah on the whammy trade. I could have gone really conservative. I don't like to on this trade. I like to be fairly aggressive. I could have gone really conservative and put my order here with a sell stop right there instead of going in at the market price. I like getting in at market because I have the stop so far away from the candle. I like getting in at market because it just enables better reward to risk ratio. But you're going to get stopped out, and it's not going to be necessarily like one of those systems where like, woohoo, I've got an 85% win rate. That's not going to happen with this. So that would be another way to do it. But look at what that does to reward to risk. Obviously, if I have my sell order there and my stop loss up there, I've added 10 pips. So now, even if I get down to 100 pips, I'm still at 2.9 R result instead of the 4.3 R result. So I'm only making 2.9 R on my winner instead of my 4.3 R winner. So that's the trade-off. You miss out on some of the losing trades or a lot of the losing trades, but you lose that on R. Now, let me go back to the, so there are alternative entries for this one. Now, let me go back to the, you know what? Does anyone have a pair you want to use? I was going to go back to the Kiwi, but I want to show you an alternative entry on the mullahs and the whammies. There's another aggressive entry that you could use outside of what we've looked at here in terms of the whammies and the mullah. So like you could go, boom. Here's a Canadian dollar. Let's see here. What I'm looking for. What about on the daily? What are we going to see here on that daily chart? What about that daily chart? Here's one. Okay. This would have been a loser. Well, actually, this isn't a good one because it actually made a lower low here, so that's not a good setup. What we really want to see on these double bottoms is that the double bottom is basically the low, or the double top is basically the high. I want to show you an alternative way of getting into these if you want to get kind of aggressive. Canadian, I'm not feeling the Canadian dollar. I'm going to go to the euro. Give me some euro action. It is so good to be away from the charts and then come back with a fresh perspective. I love, 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 love when that happens. Just so much easier to trade what you see instead of what you think. I don't know if you found that, but I certainly have. Okay. So, all right, let's go with this one right here. So let's say that we have a zone right here, okay, and the market the market hits it, okay, and then we go up. It's hit it again right here, and it's moving away from it. Now, let me zoom in on this one. January 2nd. I want to talk about this because this is a really important distinction when you're looking at different entries. So here's touch one right here, just so you're following along, right? We're talking about a moolah top. So the first one we talked about today. So there's your moolah top, and then it falls away immediately. Great. Question is it going to come back up and touch it? And it looks like answer is yes. It's coming back up here. And we don't know at this stage, we don't know if it's pausing here, it's going to go up and further into the zone, or if this is it. It's just slowing down. Momentum slowing down with these two candles. And boom, now it looks like it's falling away. So we say, okay, this could be touched too, right? So remember, the old school way of doing this would be to wait for a bearish candle, which again, I would not qualify either of these as bearish candles. I would actually wait until this candle. That would be my trigger candle where I would put my sell stop below the low there. So again, your sell stop goes down there. Whoopsie. How did I do that? Okay. So the sell stop goes right here, below there. My stop loss goes up here, above the first high, always on the moolah and the whammy. So there's my stop loss up there. And then I say, okay, Mr. Market, what are you going to do now? Are you going to trigger this in the next two candles, right? Answer is no. So I don't take the trade. Okay. But here's 1, 2 candles go and it never triggers even if my stop order is right, my sell stops right here, it still doesn't trigger. Okay. Which is probably closer to where it would be. All right. But now I want to show you another alternative entry, which is here. What you do with this alternative entry, just like I showed you the alternative entry on the ghost peaks and the ghost valleys, which is to wait for that trigger candle, and then when you see the signal candle, you don't get in at the close of the candle. You wait for the market to push below it. You can do the same thing here with the M. So this is what we call like an M entry. So with the moolah, we know that it's an M where the market hits, boom, comes back down, and then hits it again. It's making that M on the line chart, right? Now I know this one came back up, but this M entry is a very, very conservative because you've got these really wide stops. But what it does, it helps you avoid, well, not in all instances, but in a lot of times, you're going to avoid, if like this is forming a squeeze play, which is one of my favorite breakouts, then this is never going to get triggered. Also, if this is a box, a consolidation box, like I was showing you in the first chart that we were looking at, which was the Kiwi, if this ends up being a consolidation box, you're probably also not going to get entered. You might on a spike lower, but a lot of times you won't. So what this M entry does, you're only in the sell trade if the market trades lower than the M. So this is kind of an old school way of trading double tops and double bottoms, but because you don't, it kind of takes the guesswork out of it. Because before you had to guess like where's the bearish candle, where's my signal candle? Here you're just saying, look, if this is a true double top, here's what it's going to do. When it hits number 2, top number 2, touch number 2, it's going to fall back down and it's going to clear this M. It's got to clear lower than here. And when it does, I'm in. And so in this case, you would be in, but like way over here. Now, the bad news with this is like, how do you know when to remove your order? With a standard trigger candle, you go, well, hey, it's 2 candles and I'm done, right? But not with this. With this, what ends up happening is you have to go, oh, okay, well, it's more of a look. You say, well, it's kind of looking like it's consolidating here. It doesn't really look, at this stage, it doesn't really look like a double top anymore. It's looking more like, like it's just a box. So maybe I remove my order right here. I get out of my order, and then boom, actually that's when I would have been triggered. But that's okay because this one wouldn't have really gone very far. It just went a little bit lower and then it stops you out. So would have been a loser either way. I just wanted to show you what an M entry looks like. Are there any questions about that? Is that making sense? The old M entry? Yes, indeedy. Are there any charts that you guys would like to see right now? So based on what the market's doing right now, are there any charts that you would like to see? Because we can look at those from a naked point of view if you so choose. You can certainly do that. No worries, Phil. Hope it helps. So I'll just let the cat out of the bag. I think the trade of the year is still to come, and I think it's going to be, I just call it male intuition, if you will. I think it's going to be on this pair right here. And I know it doesn't look very good right now. It doesn't look very friendly. It doesn't look very nice at all. But I do believe in my trader mind that we will see this beautiful looking chart, this Aussie yen chart, one day, probably this year indeed, absolutely get obliterated and fall through the floor. But we're not there yet. And I think you're going to have to go way back to see where it's going to go. Like, hint, hint, GFC style. I think, now remember where we're at right now. It's at 82. I think we are going to see, it may be next year, but I think it could possibly be this year. Remember, this year's winding down. There aren't very many months left. I think there's a good possibility that we will see our good friend, the Aussie yen, fall through the floor and trend on like only the Aussie yen can. So I am looking for a potential trade of down here. Maybe we'll talk about why in another webinar, but this, obviously it needs to break this level, but if it breaks that level, if it breaks 75, boom, it's going to 56. So this is, to me, I think we're still we've got some moves still to go in the year. And for me, for my risk capital, I am looking forward to trading the Aussie yen and selling that sucker all the way down, not to 74, but all the way down to 56. So we'll see. We shall see. Thanks so much, guys, for your time. I really appreciate it. I hope you have a wonderful trading week, and we'll see you soon. I hope that you have a wonderful week, whether you're trading, whether you're back testing, whatever you're doing, and we'll see you in another webinar. Thanks a lot. Have a great day. Thanks, guys. Bye.